Ladies and gentlemen, dear friends, I am very happy to introduce our new webinar today. It's a tradition for our chamber to each year hold a tax seminar, as this is a subject that is so much changing year by year. This is valid for China, this is valid for Belgium, for many countries. Tax systems do have adaptations each year. Therefore, when you do business with China, you should also be aware of some new rules and regulations. And today we decided to discuss the new China's advanced tax ruling system and the golden tax system. You will get more explanation about that in a few minutes. And I would like to thank very much Ernst Young to have been our partner in this webinar, and in particular, Mr. Troy Sun, who will be our guest speaker today. Let me introduce briefly Mr. Sun to you. Mr. Sun is a director of the Ernst Young transaction tax practice in Shanghai. He will talk from Shanghai. He joined EY Shanghai office in 2010 as a graduate, and he has worked across several services within the company, including the business tax advisory, the assurance, the transfer pricing, and so on. He has worked in Ernst Young New York office in 2019 for an 18-month period, and he has also had an extensive experience in automotive, in retail, in manufacturing, in chemicals, in pharmaceutical, real estate, education, advertising, financial services sectors, through working with leading private equity houses and multinational clients in China. Therefore, we thought he's the best placed to be our speaker today. So, Mr. Sun, I will leave you the floor. Thank you very much.
Thank you, Mr. Bernard, for the introduction. Yeah, hello everyone. My name is Troy Sun. As introduced by Mr. Bernard, I'm based in Shanghai. I'm working in EY Shanghai tax team. And I've been working in EY tax team for more than 14 years. So today I'm very honored to be invited by Belgian-Chinese Chamber of Commerce to share some of the key updates for the China tax rules and the China tax system. So please allow me to share my screen first. Okay. Okay, broadly speaking, I will cover two main topics today. One is the latest progress on advanced tax ruling practices in China. And the second one will be the primary changes introduced by the Golden Tax 4 systems. Additionally, if time permits, we will also discuss some of the latest regulations regarding Hong Kong companies applying for Hong Kong tax resident certificate, if there's enough time. But we will start from the major two topics first. So let's start from the advanced tax ruling topics. Advanced tax ruling definitely will enhance the certainty of the tax policy application and reduce the operational costs for business and optimizing the tax business environment. On December 29th, 2023, the Shanghai Municipal Tax Authority issued the interim measures of advanced tax rulings in Shanghai. This Shanghai measure marks the first systematic regulation issued by Chinese tax authorities regarding the advanced tax rulings, which has significant meanings to China advanced tax rulings practice. However, as a trial version, the Shanghai measure still have some rooms for improvement. We will discuss later. The system of advanced tax rulings originated in Sweden in like 1911 and has evolved over a century into an internationally recognized mature taxation practice. Despite the discussions on this topic since 2012, mainland China did not formally introduce an advanced tax ruling system before 2023. So here you can see that we listed a timeline of the notable milestones for China advanced tax rulings practice. In October 2012, the State Taxation Administration signed a compliance cooperation agreements with 3 groups, including CNOOC, China Life Insurance, and Siemens, piloting advanced ruling services. In September 2013, Ma Anshan Iron and Steel Group applied for an advanced ruling during its restructuring case in Anhui Province, with tax authorities confirming that no VAT will be levied, marking this is a mark of the first local application of advanced tax ruling. And in December 2015, the State Taxation Administration outlined the need to explore a system for complex tax matters. And in June 2020, the Guangzhou Nansha Development Zone Local Tax Authority issued the interim measures for complex tax matters advanced rulings, which is the first public document detailing the process. In May 2021, the departments in Guangzhou and Shenzhen jointly released the joint advanced rulings on international tax matters, providing tax certainty for large multinational corporations in cross-border operations. In January 2022, Shanghai, Zhejiang, and 3 other regions announced measures supporting the integrated development of Yangtze River Delta region, mentioning exploring integrated advanced rulings for large enterprise. And then in 2023 and 2024, Shanghai and Beijing respectively issued the formal regulations on advanced tax ruling practice. So until 2023, the explorations into advanced tax rulings primarily focused on the specific tax issues for large enterprises without a comprehensive system. Conversely, the 2023 and 2024 regulations from Shanghai and Beijing have the following features. Firstly, it is applicable to all corporate taxpayers in Shanghai and Beijing. Not just for the state-owned enterprise or large multinational companies. Secondly, there's no restrictions on the applicable taxes. So theoretically, it covers all taxes managed by the local tax authorities. Third, it is applicable to anticipated complex tax matters, but not to those matters that are without a project plan, or the matters will occur after 2 years, or the matters lacking of commercial purpose or prohibited by the law. So both cities may further advance the inter-provincial cooperation, particularly in the Yangtze River Delta region, which Shanghai is the center city, and the Jing-Jin-Ji region, which Beijing is the center city. So Shanghai and the Beijing measures also provide detailed application procedures, including the submission to any level of the large enterprise tax management, coordination by a leading tax office, examination by a steering committee, and the issuance of a stamped advanced tax ruling opinion. The measures also provide timelines for acceptance, handling, forming preliminary opinions, and providing feedback. So here you can see we listed a chart which basically described the detailed application procedures in the Shanghai and the Beijing measures. So following the release of Shanghai's measures, the Municipal Tax Bureau issued the first two advanced tax ruling opinions. One is related to the special income tax treatment for corporate restructuring, and the other one is related to the VAT and the land appreciation tax incentives, which is in the expected land reserve scenarios. It is important to note that the obtaining an advanced ruling does not guarantee absolute security. That's some like we want to share with you. The taxpayer must consider its binding force and monitor ongoing compliance. The taxpayers should also stay informed about local developments and actively leverage policies to enhance the tax certainty. So here is some like key takeaways from EY. First one is we should like focus on the effectiveness and binding force. The advanced ruling opinions apply only to the specific applicants and matters, not automatically to like other similar cases for other taxpayers or the same taxpayers' operations in different regions. They usually have a valid period requiring renewal if the transactions extend beyond this time frame. And the non-compliance can lead to the termination or revocation of the ruling. Second one is the legal remedies. In some areas like Shanghai, advanced rulings are not subject to administrative reconsideration or litigation. So disputes arising from the application can still seek legal remedies through existing channels, though proactive communication with the tax authority will be encouraged. And the third one is stay informed and utilize policies. With examples like joint rulings for non-resident enterprises in indirect share transfers, advanced tax rulings can save a lot of resources for both taxpayers and the tax authorities. Given the complexity, seeking professional assistance for cross-border tax matters is advisable. Let me take a step back on the previous page. As you can see on the bottom, although the Shanghai Tax Authority shared two cases for advanced tax rulings, the other tax matters like the indirect share transfer matters, the significant asset losses deduction, and some equity incentives, the individual income tax implications on the equity incentives should also be considered to do advanced tax rulings if such topics are very complicated, because these topics normally will involve a huge amount of tax cost. Okay, then we can, I think we can move to the next topic. The next topic is the golden tax systems in China. As you can see, the digitization of the tax administration. In this topic, I will outline how the upgrade from phase 3 to phase 4 represents a significant leap forward in China tax administration capacities, and enhancing efficiency, transparency, and regulatory oversight. So before we dive in, let's introduce a little bit about the tax systems in China. The golden tax system, or we can call it Jing Shui in Chinese, is a series of comprehensive tax management systems implemented in China to modernize tax collection and management process. These systems integrate advanced technologies to streamline tax declaration, payment, and supervision. So the golden tax system phase 3 launched several years ago which is marked a milestone in unifying national and local tax data, creating a single platform for managing both state and local taxes. It was designed to provide real-time monitoring of the tax-related business, ensuring the compliance across the country. By integrating the tax data, it significantly reduced the instances of tax evasion and the streamlined tax administration. So this is a recap of the Golden Tax System Phase 3, but now the tax system are moving to the Phase 4. So let's dive into the key differences between the Golden Tax System Phase 4 and Phase 3. First one, the scope is expanded. So unlike the Phase 3 tax system, which preliminary focused on the tax matters, Phase 4 extends its reach to some non-tax activities as well. This broader scope allows for a more holistic view of a company's financial health and compliance, going beyond traditional tax revenues to include social insurance contributions, for instance. And secondly, it is the enhanced data sharing and verification. Phase 4 Golden Tax System established a robust information sharing infrastructure among various government agencies, government authorities, including like the mobile companies, the banks, and the various other governmental departments. This facilitates real-time check on key company details, such as the mobile number of the key personnel, the tax status, and the registration information, greatly enhancing the speed and accuracy of the audits and inquiries. The third one is a cloud-based smart taxation. Embracing cloud technology and big data and analytics, Phase 4 tax system enables the cloudification of data in the process, leading to intelligent tax services and smart regulation. And this transition not only speeds up tax-related tasks, but also empowers tax authorities to analyze data patterns and identify potential risks in real time. And also for the in-depth monitoring, one of the most notable enhancements is the system's ability to conduct multi-dimensional monitoring of a company's income and expenditure, including closer monitoring of Social Security contributions. This means the transactions that might evade taxes, such as purchasing fraud invoices, in previous market, can be deducted almost immediately with swift follow-up investigations. The fifth one is the cross-department collaboration. Phase 4 tax system fosters better collaboration between different government authorities, enabling cross-checks and information verification that were previously impossible. And this interconnectivity ensures the tax evasion activities that may have slipped through the cracks are now much harder to execute. The sixth one is the increased tax compliance. The enhanced features of Phase 4 put greater pressure on companies to maintain accurate financial records and strictly follow the tax rules and laws. It reduces the feasibility of using personal accounts to avoid taxes and pushes for higher levels of financial standardization across the business. And seventh is the modernized infrastructure. And I think I put the 7 items at the last, but it may be the most important part for the companies. Technologically, Phase 4 is built upon the advancement made in Phase 3, further leveraging AI, machine learning, and the data analytics to refine the tax management. This modernization aims to reduce manual workload for tax professionals while improving overall system efficiency. The impact to the companies are one of the major impact is now the China tax systems are using full-scale e-tax invoices now, instead of the paper invoices used before. A lot of our clients were informed by the in-charge tax authorities that they are no longer using, they cannot use the paper invoices anymore. They cannot apply for the paper invoices anymore. They must to do the transition to the e-tax invoices in a very short time period. And this will be a huge challenge for the company's tax system. They need to build a new tax system to use the full-scale e-invoices. And another one is previously for the non-resident enterprises, if they want to do some tax filings in China, it will be quite difficult because they don't have any tax registration number in China. So previously, we may help the client to do offline filing in the tax hall, tax authority, and we need to talk to the tax officers how to do such offline filing on behalf of the non-resident enterprises. But now the new online cross-border tax systems were introduced. So the non-resident enterprises can also file their, can also do the tax registration, temporary tax registration on the line, and they can also file their taxes on the line. So these are two major impact on for the modernization in infrastructure. They are built on the phase 4 tax system, golden tax system. Yeah, I think we still have time, so I will quickly go through this topic, which is the adjusted approach to the issuance of Hong Kong certificate of resident. Maybe I will take like 2 or 3 minutes for that. Actually, in 2023, June 2023, the Hong Kong IRD tax authority has revisited its approach to the issuance of Hong Kong certificate of tax residency and announced that a simplified approach will be applied. So basically, for any enterprises incorporated in Hong Kong, they can apply for the Hong Kong tax resident certificate, and they are only required to provide basic information on its business. So unlike the previous practice, like in previously, the Hong Kong companies which wants to apply for the tax residency certificate, they will need to provide a lot of information about their business, like the business substance, the office address, the employee information, the board information to the tax authority. Then the tax authority will decide whether or not to issue such certificate. But now, as mentioned, only basic information should be provided to the tax authority, and basically the tax authority will issue the tax resident certificate to the companies without any inquiries and challenges. So this is a significant change for the Hong Kong tax resident certificate. But the impact in China is like, if we are talking about Hong Kong and China tax treaty, if you want to enjoy some treaty benefit under the Hong Kong-China tax treaty, then the tax resident certificate of the Hong Kong company is a must item to be provided to the China tax authorities. So a simplified approach will definitely save a lot of time when applying for the tax treaty under Hong Kong-China tax treaty. But we want to like EY's insight is like the certificate of the residency is only the first step in claiming the tax benefits under the tax treaty. The Hong Kong company still needs to have enough business substance, enough employees, enough board meetings held in Hong Kong, something like that, to satisfy the the requirements of the beneficial owner regulated under PRC tax rules. So obtaining a Hong Kong certificate of resident does not mean that that the Hong Kong company can already benefit from the tax treaty benefit. So that's the brief introduction of the Hong Kong tax residency certificate update. So I think that's pretty much all of my sharings today. So I will pass back the mic to Mr. Bernard. Yeah.
Thank
you, everyone.
Thank you very much, Mr. Sun. Thank you for your very clear expose and very interesting slides too. And I hope we will be able to share these slides later on with all the participants. We have now time for a few questions and answers, so do not hesitate to join us through the chat box with putting your remarks or questions. I have a first question, and that relates to your last topic about the Hong Kong certificate of residence. I'm wondering, is it in your mind still, as it was several years ago, a certain number of companies, when in order to do business with China, were establishing first a company in Hong Kong, and the company was then going to China? Do you think that from the tax point of view, it is still interesting to have a vehicle in Hong Kong going to mainland China, or do you think it's not absolutely necessary and to be directly active in China and benefiting from some of also the tax advantages in mainland China?
Yeah, I think that's a good question. Like before, several years before, the multinational companies, they will set up a Hong Kong holding companies and then invest into China through the Hong Kong holding companies. But now I think because of the PN9 regulated by China, there's a public announcement 9, which regulates how to enjoy the treaty benefit for the dividend repatriation and the interest repatriation. So if the Hong Kong company does not have enough business substance, then the tax saving may not be like significant, because if the Hong Kong company does not have enough substance, then the dividend repatriation and interest repatriation from China to Hong Kong will not enjoy a lower tax rate. So from tax perspective, so my advice will be like Hong Kong is still a very important economic center in Asia. So if the company really has businesses considerations in Hong Kong, like trading or finance activities in Hong Kong, then a Hong Kong holding company will still be a very good option to hold the PRC enterprise, because the because the Hong Kong and China tax treaty provides a very good withholding tax rate for the dividend and the interest repatriation. But if you don't have any business requirement or activities in Hong Kong, then maybe to seek another location or directly invest into China will be a better option. But it will depend on the treaty benefit between the China and other countries, and to pick a location for the holding company.
Thank you, Mr. Sun. Another question. We see for the moment many different cities from mainland China wanting to attract foreign investors, foreign companies. And when I listen to you, we see that, and Shanghai has always been very much advanced in China. We see that you have now this advanced tax ruling systems put in place in Shanghai, now in Beijing, as I understood from your expose. What would be your suggestion for a new for a company coming now to China? Should they pass first through Shanghai or Beijing instead of going directly to another region, province or city, where you do not have yet this tax ruling system?
I don't think the tax ruling system is very key, has a very key impact on the location picking, because most of the tax issues, daily issues, they will not go through the advanced tax ruling system. Only the big issues, like mentioned, the special restructuring, indirect share transfer, something like that, which may have significant impact on the companies, we may go through the advanced tax ruling system. And it's brand new, so it's not very mature in China. So I don't think this is a key items which can impact, which will have the impact on the location picking. I think the most important thing is which city is more like how to say, which city like is more welcome the multinational companies. I think the answer is definitely Shanghai. Shanghai has the most has many like multinational companies, and for Beijing, as Beijing is a capital city, but more state-owned enterprise or private-owned enterprises are their headquarters may be more based in Beijing, but for the multinational companies, normally their first step will be in Shanghai. But as you mentioned, a lot of cities are using different ways to attract the investments from multinational companies. It can be further analyzed, like the financial support, like the tax policies, also the financial subsidies provided by the other regions. More of our clients are moving Western, because in Western region, Western region cities, they have a reduced corporate income tax rate of 15% compared by the statutory rate of 25%. It's like called 西部大开发 policy, Western region development policy. So more, some of our clients are establishing companies, factories in the Western cities like Chengdu, like Chongqing. And a lot of our clients will ask us to do a location study for their location picking. So we definitely have a lot of experience in helping the clients to pick their operation cities or operation province from either the tax perspective or from the financial perspective.
Right. Mr. Sun, our treasurer, Mr. Eric Famay, has a question. Could you mention something of the tax benefit, if any, that's available for foreign companies in Hainan? We know that Hainan has the free trade port concept now going on. Could you make a comment on that?
Yeah, if it is an encouraged business, the company establishing in Hainan, if they're engaged in the encouraged business, then the company can enjoy a 15% reduced corporate income tax rate. that's the first 15. We call the 215 policies. For corporate income tax perspective, 15% reduce the tax rate, and for the individual who worked in Hainan province, they can also enjoy a 15% effective individual income tax rate for their salaries and bonuses. Normally, the individual income tax rate ranges from 3% to 45%. It's a progressive rate, but if the employees who worked in Hainan, then the effective individual income tax rate can be reduced to 15%. So that's the two major tax policies introduced by Hainan province.
Right, thank you. Another question from Mrs. Maria Polakova. Shall I pay the income for the equity gain in China as a foreign investor? And what's the procedure, please?
If you are disposing the equity of a PRC enterprise, and the seller is a non-PRC resident enterprise, then the capital gains will be subject to 10% statutory income tax rate in China, and technically, it will be subject to who is the buyer, right? If the buyer is PRC corporation, then the buyer will be the withholding agent, and you don't have to, as a seller, you don't have to worry about the taxes because the buyer will withhold the taxes from the considerations and pay the remaining consideration to the seller. And if the buyer also a non-PRC resident enterprise, then in practice, the seller will have to file the taxes by itself. Like I mentioned, the golden tax system phase 4 introduced an online system for the non-resident enterprises to file their capital gain taxes in China. So actually, the tax agent or the company itself can log onto the tax system and apply for a temporary tax registration number, and then file some tax filing forms and submit to the tax authority, then pay the taxes all on the line. Theoretically, it worked. It can be workable, but in practice, because the new system may not be that mature currently, so if you are a non-resident enterprise who needs to pay the taxes in China, you may still need some tax agent to help you to do that.
Okay, well, thank you, Mr. Sun. Question concerning the timeline for the advanced tax ruling, because you have indicated that for certain steps it is 15 days, 30 days, but in total, what would be the average time between the first step of the company with the administration and the ruling, I would say?
I think it's hard to estimate, but I would say if it is big, because for the advanced tax rulings, the tax issues should be quite complicated. So I would say it is very hard to estimate right now because currently we don't have many cases on hand. It is a newly introduced approaches by the Shanghai Tax Authority. We only have 2 public cases. But if you want me to give you an estimation, I would say maybe 2 or 3 months, 2 to 3 months will be the minimum period to do that advanced tax rulings.
Right, which is already quite a short period when
Right.
you compare with some other system. Mr. Sun, I want to thank you very much. I would briefly make a little summary of what you said, which you will find back in your slides. You raised the two main topics, which was the progress of the advanced tax ruling, and you gave also the history of this, starting from quite a certain time, and with the dates of 2020 with the Nansha district in Guangzhou, starting with some first step, then Guangzhou Shenzhen, then the Yangtze River Delta advanced tax ruling practices, and arrived in Shanghai in December 2023, and Beijing this year. You detailed the scope of application of the measures with companies, taxpayers in Shanghai, concerning also complex tax matters that are expected to take place in the future. Therefore, also I noticed also during the questions and answers that it will be more for project of a certain dimension, I would say. You have also detailed the request, the assessment, the decision, the timetable for accepting, and the request. You notice that once you have the ruling, it's maybe not fully secure, and you made some suggestions for enterprise taxpayers, and also notice that maybe communication with the tax authorities is still very important, and for that you definitely need professionals like you, Mr. Sun, and your company. The second topic you raised is the famous golden tax system, with also detailed what had been done in phase 1, phase 2, phase 3, and now we are in the phase 4, which is the phase of the digitalization of the tax administration. You have detailed the differences with the phase 3, which we find in the phase 4, with the full-scale rollout of fully digitalized e-invoices. That's also very important. The administration insisting now on the use of e-invoices, no more of the paper invoices, with also the obtaining of a unique tax identification number. You have noticed that AI, the artificial intelligence, is playing a bigger role also in the tax system. You have explained to us what is the impact for companies of the new phase 4 system put in place, with as I mentioned, the full-scale use of e-invoice, with the fact that non-resident enterprises can file tax registration online, which should make it also more easy. And finally, you raised a third topic, which is the issuance of Hong Kong certificates of residence, and noticing that any company incorporated in Hong Kong can apply for the tax residence, but be careful. Your Hong Kong company should have a real business substance. That is also something important. Shell companies, be very careful. And the fact that obtaining the famous certificate of residence is not the end of the world, as the authorities are not stupid and are also checking the reality of the company, of its activities, and its impact on taxation. So, Mr. Sun, thank you very much for your very clear expose, very detailed. I would suggest to our listeners, if you have later on a further question, do not hesitate to be in touch with Mr. Sun directly. You will get also his details when you get the slides of today. Mr. Sun, thank you very much. I would like to also to invite our listeners to continue to follow our activities through our website, through the emails that you will receive for our next activities, our next webinars. Month of June will be a busy month. We will have many activities, so please stay in touch with us. Mr. Sun, thank you very much. And if you are passing through Belgium, we would be very happy to welcome you.
Sure. Thank you. Thank you, Mr. Berner.
Thank you.
Yeah.
Bye-bye.
Bye-bye.